Ground. See, the US government wants to help people, help their people buy property, right? Or be able to, so they want to help their people to be able to buy their own homes. Now, how do they do it? How do they do it? Let's say there's a bank, and that bank is not willing to give you a loan. So you're sad. But that's where the US government comes in and says, we will guarantee this loan, right? In case this person is not able to pay you, we will pay you. That's what they say to the bank. And then the bank says, okay, no problem. Since the US government is taking responsibility, then we will give them the loan. So this is how the US government helps people get home loans. Now, not everybody is eligible for this. There is something known as conforming loans, right? So what does that mean? First of all, you have to have a good credit score. So if you're not really taking care of your credit score, you can't get the government to back you up on this. Number one. Number two, the government wants people to live in suburban areas. So usually they will try and promote people to go and get these loans in suburban areas, and that is what conforming loans are. So agencies back conforming loans, and this helps people to be able to buy their own homes in suburban areas, and this is part of the government's agenda. Now, why is this important for us? Because when we talk about asset-backed securities, and within asset-backed securities, we talk about mortgage-backed securities. And within mortgage-backed securities, there are two types. One is those that are backed by agency, so agency mortgage-backed securities. And then there are those that are not backed by government, that will be called non-agency mortgage-backed securities. So as an investor, obviously you would feel safer buying those mortgage-backed securities which have mortgages backing them that are guaranteed by the government or government agencies, right? So it's obviously safer. Agency mortgage-backed securities are much safer, right? There is almost zero credit risk in them. Whereas non-agency mortgage-backed securities will have very high credit risk, right? Now, who are these agencies? There's three: Ginnie Mae, Fannie Mae, and Freddie Mac. Now, these two are private. They're not actually government, right? They are private, whereas this Ginnie Mae is government. So for G for government, G for Ginnie Mae, and these two are F. So they are not government, they are private. But they are very heavily regulated, private but heavily regulated by the government. So what we call them is government sponsored enterprise. So it's not the government, it's like an agency which is sponsored by the government, but that doesn't mean they're backed by the government. They do not carry the full faith and credit of the US government, unlike Ginnie Mae, which is government, right? So there is a difference between these two. However, even Fannie Mae and Freddie Mac, we feel are, because they are so heavily regulated by the government, that their guarantee is considered very, very good, right? Almost zero risk is there. So that's one thing. Number two, I mean, you don't need to know so much detail, but I'll just tell you, is that Fannie Mae is for big loans, big banks. They help big banks guarantee the loans. that they are giving out, and Freddie Mac is for smaller ones, right? These are for smaller loans, and they don't deal with the big banks. They deal with the smaller banks or the saving corporations and stuff like that. But I mean, don't worry about it too much. You just need to understand the high level difference between agency and non-agency. So this entire thing that you see over here is agency, right? Whether it is Ginnie Mae or Fannie Mae and Freddie Mac, it is all agency, and this is safe, right? This is safer compared to non-agency, which is high risk. And that is why, if you think of credit tranching, where you create different tranches to distribute credit risk, right? Credit tranching is more relevant for non-agency RMBS because that's where the high credit risk is, right? But for agency RMBS, there's not much point doing credit tranching because there's not much credit risk. So what we will want to do over here is time tranching because there is still that prepayment risk, right? Because this is residential mortgage-backed securities, and residential mortgage-backed securities, people are allowed to make prepayments. You cannot stop people from making prepayments, right? If they want to pay off their mortgage, can you stop them? Can you tell them, no, you cannot pay off your mortgage, it's not allowed? You can't do that, right? Because it's their right. This is residential. When we will move to commercial mortgage-backed securities, the terms with them are a lot stricter, right? We don't allow them to pay off their mortgage earlier than they were supposed to so easily. We'll put a lot of penalties on them. But when you're dealing with residential families, we don't actually put a lot of penalties on them for paying before they were supposed to. And therefore, prepayment risk is a serious concern even within agency RMBS, and therefore time tranching is a good solution for that, right? So what do we have here? We have your normal mortgage pass-through securities, and we also have collateralized mortgage obligations. And what's the difference between these two? So in your first one, in this one, the SPV is backed by a pool of mortgages, right? In the second one, and you probably already know this, is that it's not a pool of mortgages, it's a pool of asset-backed or mortgage-backed security. So it's like a two-layer sort of a thing, that you have a pool of mortgages which then creates asset-backed securities, and then you get into a pool of that, and then you create mortgage obligations, collateralized mortgage obligations, which we talked about earlier, is that then you'll have a collateral manager in the middle, and then they can, in addition to getting the cash flows, they can also do trading in those securities and, even get into derivative transactions. So as long as they're dealing in agency mortgages, whether just directly giving out the mortgages and getting a pool, or dealing in mortgage-backed securities of agency mortgages, either way, this is going to come within agency RMBS because the base, the foundation is mortgages which are backed by government agencies, right? And if you're getting into the world of non-agency, well, now there is risk. So what you need to do, you need to fix that risk. How are you going to fix that risk? Well, you could do credit tranching. You could also do credit enhancements, right? And we talked all about those. You can have over collateralization. You can have the difference in the spread, right? In the weighted average coupon that the pool gives you versus what you're committing to the investor. So you can have a excess spread there. There are other things that we talked about, such as a bank guarantee, surety bond, etc., right? And of course, if you have agency backed, well, there's no credit risk because these are what we call conforming loans. And what are conforming loans? Conforming loans are those ones which satisfy the underwriting standards of the government agencies, which to start with means a good credit score, right? So already it is a prime loan that you're talking about because the person who's taking this loan has a good credit score. And then of course the property is going to be nice and the value and everything compared to the loan. So all those underwriting standards are confirmed with, and therefore the agency also backs it. So the risk is very, very low as far as credit risk is concerned. Of course, prepayment risk is there, and you can solve that with time tranching. Now, when we talk about recourse to the borrower, right, as a feature and prepayment option, we're going to talk about both of these in detail. But before I get into the details of both, I just want to help you clarify the difference when we use the word recourse in case of covered bonds. So what did we talk about when we said covered bonds? We said, okay, so here is an investor and there is a certain pool of assets, right? And if this pool is not good, then the investor has a recourse to the bank as well, to the bank's other assets, or the bank has to replace good assets into the pool. That is not the recourse that we're talking about over here. That is in the case of a covered bond. The recourse we are talking about over here is that within the pool, there are mortgages, right? There are mortgages. And let's say there is this fellow that has taken this mortgage, and let's focus on this fellow right now. Let's say this individual is worth $200,000, but the house is only worth $100,000, right? And we have given them a loan of, let's say, $800,000. Sorry, $80,000. Now, what happens is, let's say this house crashes. For some reason, this becomes worth $70,000. Now, how are we going to recover our 80? If it is a non-recourse loan, which is usually the case with individuals, right? We cannot go after this person's personal assets, right? Non-recourse means we cannot go after their personal assets. But if it is with recourse, then we can go after their personal assets and get the remaining 10,000 from their personal assets. So that is the recourse to borrower, to the borrower that we're talking about over here. This is not investors' recourse to the original issuer. We're talking about within the pool, that the borrower is behind the pool, right? So that is what it is. And prepayment option is, of course, paying back earlier than expected, or retiring the bond earlier. Now, I told you this is residential mortgages that we're talking about, and it's not very likely that we are going to be very rude with these residential borrowers and force them to pay heavy penalties if they want to prepay. In some countries there is, and there can be a penalty, right, for prepayment, and that's to stop the lender from facing prepayment risk, right? So the objective of imposing that penalty is to compensate the lender, the investor, for getting that prepayment earlier than they were expecting, and that usually happens in the case of an interest rate decline. So think about it this way: there's a pension fund, right, and they have a mandate to earn 5%. So they invest in these asset-backed securities, mortgage-backed securities that promise to pay 5%, and then the interest rate goes down. And what happens is, these people who've taken the mortgage want to prepay and not pay that 5% anymore. So they want to get rid of this loan and they want to get it refinanced. So the pension fund will be sad, right? Because they thought they would be able to earn 5% for the next whatever, if the weighted average maturity was 30 years. So they were just relaxed because they thought they had invested for 30 years for 5%, and then suddenly all the money comes back, and then when they go out and try to find new investments, everything is available at a coupon of 3%. So they are then going to get very sad. So this is why lenders would like to protect themselves against prepayment risk, especially if interest rates are expected to go down. But that is hard to do with residential mortgages, because you cannot stop these people wanting to pay back their mortgage early. So that is why we come up with time tranching, whereby we say, okay, they can be a packed tranche, right, with a planned amortization schedule. So pack tranche, and then you have your support tranche that then faces all the expansion and contraction risk. And with respect to the recourse and non-recourse, this is with respect to the borrower, right? This is with respect to the borrower that can, within the pool, can you go after this person's personal assets if the value of the property is not enough to recover the loan amount, right? So if you do have a recourse loan, then you can go for their personal property like an expensive car or valuable art, but that is usually not the case. Usually what we have is non-recourse loans, right? And we can only focus on the property, and that's it. We cannot go after their personal assets. Right. So still we are in the world of residential mortgage backed securities, and we're going to break this up into first pass through securities, right, where what's basically happening is that the cash flow from the mortgages is being passed through to the investors, right? And let's talk about these cash flow characteristics. What's basically happening is that you've got that original bank that originate to distribute model. It originates these mortgages, right, and then hands over the ownership to the SPV, which then issues these asset backed securities, these mortgage backed securities, right? Since it's a pool of mortgages, so hence this asset backed security is a mortgage backed security, but the bank stays on board as a servicer. Now, this is something I've been telling you for a while now, since the beginning of our discussion on asset-backed securities, that the bank stays on board as a servicer and they collect service fees. So when we talk about pass-through securities, what's happening is the cash that is being generated from this pool doesn't directly get passed through to these guys. There is a service fee. There is a service fee that will be deducted, right? So the servicer, which is usually the bank, it doesn't have to be the bank, but usually it is the one that originated, because they already have a relationship with all those people. They have that network. They are the ones who originated those loans, so they are in a good position to service them as well. But they take a fee. Therefore, the amount of cash flow that the mortgage is generating versus the amount of cash flow the investor is receiving is not the same, because you are going to minus the servicing and other fees from what is generated before giving it out to the investor. So that is a very simple concept. Right. So let's say if your pool is generating 8%, right, and the servicing fee is 0.6, so then what the investor is going to get is 7.4. Now, how do you know what the pool is going to generate? Because in the pool, you will have one person who's paying maybe 6.5%, another person may be paying 6%, another person may be paying 7%. So what do you think the pool is going to generate? Well, you have to take a weighted average depending on what is the dollar amount of this loan, what is the dollar amount of this loan, what is the dollar amount of this loan, and you take a weighted average of the coupon, and that is what the pool will earn for you. Similarly, for the maturity as well, that you might have somebody who has 30 years remaining, you might have somebody who has 29 years remaining, somebody who has 31 years remaining. So you again have to take a weighted average based on the dollar amount of each loan versus the total dollar amount. And here is a question for you to just get your hands dirty a little bit and make sure that you know what we're talking about over here. So what I would say is, please pause the video, calculate the total amount of the pool, and then see what is the weight, and then apply that weight to the coupon rate as well as the time to maturity, and calculate the weighted average time to maturity and the weighted average coupon and the weighted average maturity. So please pause the video and calculate this. Right, so hopefully you were able to do it. The total is 10,000, right? And this is 10%, this is 20%, this is 40, and this is 30. And then you take that 10%, multiply it with the 4.5% coupon. Similarly, 20 into 4.75, 40 into 5.15, and 30 into 3.8, and you get the weighted average coupon of 4.6%. Similarly, for the maturity, 10% into 28 months, and then 20% into 42, 40% into 37, 30 into 60 months, and you get a weighted average maturity of 44 months. Now, weighted average life is not the same thing as weighted average maturity. Weighted average maturity can be less than your weighted average life, right? In the case of expansion risk, right? If there is an expansion, and if there is a contraction, then your weighted average life can actually be much less than what you thought was going to be the weighted average maturity in the case of a contraction. What happens when interest rates goes down? People want to prepay, so the life will be much shorter, the weighted average life will be much shorter than what you thought, and that is what your contraction is. If interest rates go up, nobody will want to prepay, right? So your life will get expanded than what you thought was going to be the maturity. Right. So I think let's take a break here, and then we'll come back and talk about collateralized mortgage obligations. You have a pretty good idea about pass-through. Now let's see how we can kind of take a pool of these securities and then do some structuring with them, right, to deal with these different risks. So let's take a break and we'll come back and deal with this.